Hello students, today we are going to discuss about the elective paper Financial Management in the 5th semester BBA. The title of the paper is Working Capital Management. The main objective of this paper is to familiarize the students with the concept and techniques of working capital management and also lease financing. Before studying in specific about working capital management, we shall discuss the context. In this regard, if you remember students, you have already studied in the second year the fundamentals of financial management subject, wherein you know that financial management is mainly concerned with the acquisition and an efficient utilization of economic resource, that is the capital fund in the organization. In performing various financial functions in the business organization, the financial manager has to take the major decisions. If you remember students, you have studied the basic financial decisions like capital budgeting decision, financing decision, dividend decisions, which are spread over different units in your second year subject. But you haven't discussed in detail the one important decision, that is the short-term decision, nothing but current asset mix decision or working capital management. All these financial decisions which the financial manager has to take is guided by the very important objective of financial management, nothing but maximizing the wealth of the shareholders. Of course, the wealth of the shareholders will be maximized when the market value per share is maximized. Therefore, we have learned that all the major financial decisions should be the optimum decisions so that the decisions result in the maximizing the wealth of the shareholders. Now, with that background, we will come to the working capital management. Therefore, in this e-class, we would be learning about the nature of working capital, current assets and current liabilities, concepts of working capital, types of working capital, need for working capital, and the operating cycle concept. Now, let us start with the nature of working capital. We know very well both fixed assets and current assets are employed in the organization in order to generate the profits. We have already studied in the capital budgeting decision how the fixed asset mix decision can be taken by the financial manager, making use of various capital budgeting techniques like NPV, IRR, payback period, and so on. Here, why this current asset management or working capital management become very important for study? The reason being, if you recall the balance sheets which you have drawn since from your first sem, you identify that the major fund of the organization is invested on the current assets. Of course, therefore, you have to bother about that investment. And at the same time, the short-term assets, the current assets are those which can be changed according to the need frequently when compared to your fixed asset. That makes the working capital management very, very important for study. Now, The working capital management, what we speak about, that deals with the relationship between current assets and current liabilities. Now let us try to understand what are current assets and current liabilities before going in detail to the working capital. Current assets are those assets which are converted into cash within a year in the normal course of business. Of course, there are various components of current assets which you can observe here, from cash in hand till the prepaid expenses. But if you remember, all these components do not have the same characteristics. This is what you are going to study in the different units of this paper. Hope you have understood about current assets. Now current liabilities. Current liabilities are those maturing obligations which have to be paid by the business organization within a year in the normal course of business. And these are the components of current liabilities. That is sundry creditors, bills payable, short-term loans and advances received, bank overdraft and outstanding expenses. Now let us understand the concepts of working capital. There are basically two concepts of working capital, gross and net. According to the gross concept, working capital refers to the firm's investment in current assets. Firm's investment in the current assets, the components which we have already observed. Therefore, gross working capital, when you focus on the funds invested on the current asset, it deals with two aspects. One is optimum investment in the current asset. Okay, it should neither be more nor be less. At the same time, how do you finance your current asset? That means what are the sources available to finance the investment in current asset? These two aspects will be focused when you take the gross concept into account. Next, net concept. As for the net concept, the working capital is the difference between current assets and the current liabilities. Therefore, here the working capital is equal to current asset minus current liabilities. Here, when you calculate the working capital, it can be either positive or negative. That means if you have current assets of 5 crores and current liability of 3 crores, then you will have positive working capital of 2 crores. At the same time, if you have current assets of 3 crores and current liability of 4 crores, then we will be having negative working capital of 1 crore. Of course, the positive working capital is very important to have the sound liquidity position in the organization. Now, what are the features of net working capital? This is according to the net concept. Compared to the gross concept, the net concept is very qualitative aspect because it tries to build the relationship between current assets and current liabilities. Therefore, when you have positive net working capital, it is a safety of margin to the creditors. That means the creditors can feel relaxed that the firm has enough fund in order to meet their obligations. And it is net working capital is that portion of working capital which has to be financed from the long-term sources of fund like equity shares, preference shares or term loans from the financial institutions. Okay, because the current assets will be financed from the current liabilities, because current liabilities act as a source of financing to the current asset. To the extent you cannot finance it from the current liability, that will be financed from the long-term sources of fund. Types of working capital. There are two types of working capital, permanent working capital and temporary working capital. The words themselves speak. Permanent working capital is that certain minimum level of working capital which is continuously required to ensure the smooth production and sales function in the organization. That if you remember, when you have discussed the various components of current asset, okay, at any point of time in the organization, you will find the funds being blocked in the form of raw material, in the form of work in process, in the form of finished goods, or in the form of debtors. Therefore, certain minimum amount will always be there irrespective of your level of production, whether you produce to the full capacity or percentage of some capacity. Whatever it may be, the certain minimum level of investment will be there always, and that minimum level of working capital which is kept for a long period of time, that is called as the permanent working capital. Next, temporary working capital. The word itself indicates temporary, fluctuating, variable. Therefore, it is the capital required over and above the permanent level of working capital. Therefore, if the firm fixes that permanent working capital is about 7 crore, okay, over and above that 7 crores, you may have to invest either in the raw material and even work in process, finished goods and so on. Why you should invest over and above that permanent working capital? That is basically due to the seasonal fluctuations in the demand. Okay, accordingly, you have to incorporate changes in your production and sales function, which leads to increase in the usage of the working capital. That is nothing but temporary working capital. If you just observe two figures here, when I said permanent working capital, that is the minimum level that will remain the same throughout the lifetime, okay, it does not mean always that once you fix the minimum level, that will remain the same forever. That means if you fix permanent working capital of 7 crores, it does not mean that 7 crores will be the same amount for a long period of time. Therefore, if it is in a case of stable firm, then you can see the production and sales functions will also be stable, and accordingly the permanent working capital once you fix that remain the same, and then variable working capital will vary according to the fluctuations in the demand. But in case of growing firm, if you observe here, you can see that the permanent working capital is also increasing over a period of time. Okay, of course variable working capital fluctuates, okay, but permanent working capital also increases. Okay. Next, we shall discuss about need or purpose of working capital. In any organization for that matter, if you just observe, there will be stock of raw materials. Why the stock of raw materials are held? They are held in order to ensure uninterrupted production, so that whenever you want to feed into the production, you have sufficient stock of raw material. That means the funds are needed to have the stock of raw materials. At the same time, the work in process, always there will be work in process till it is yet to be completed into finished goods. Again, after the completion of the manufacturing cycle, the stock of finished goods will be held till the demand arises for sale. At the same time, all the firms will have the receivables being created, because the receivables arise when the firms sell on credit. Therefore, the receivables again require the fund to be blocked. At the same time, the firms require sufficient cash balances to meet various expenses and obligations. If you remember the debit side of your trading account or profit and loss account, you have listed there various expenses, administrative, office expenses, selling expenses and so on. All these expenses have to be paid, for which the firm need to have sufficient cash balances. Okay? Therefore, these reasons, okay, is responsible for the working capital in the organization. Students, now we will discuss about the important concept, that is an operating cycle. Actually, operating cycle is recognized as the heart of the need of working capital, because this is a cycle which creates the need for working capital in the organization. Basically, cash is utilized in purchasing the raw materials and then converted into working process, finished goods, receivable and back into cash. That means to say, cash is not instantly converted into cash because of the existence of an operating cycle. To define, operating cycle is the continuing flow from cash to suppliers, to inventory, to account receivables and back into cash. Therefore, it leads to many phases in the cycle of events. If you observe the figure here, you can identify the three important continuous phases which creates the need for working capital. We shall observe now the phase 1, wherein cash is converted into inventory. The time duration of this event or this phase may not remain the same for all the concerns. It depends upon the nature of the enterprise, the seasonal fluctuations and so on. If you take the example of a manufacturing concern, the cash will be used to purchase the raw material, then it will be converted into the work in process, then work in process will be converted into the finished goods. Therefore, this cycle is dependent upon the manufacturing cycle of a firm. Of course, if you take the trading organizations, then they do not deal with the manufacturing of goods. They purchase the finished goods, have the stock of it and then sell the finished goods. Therefore, here the cycle of trading concern is limited. And therefore, the cash converting back into inventory is dependent upon the nature of the enterprises. And if you take the service organizations, as they do not deal with the goods, this phase, the first phase will be absent for the service organizations. Now we will discuss the phase 2. Phase 2 arises when the stock of finished goods are sold on credit. If the firms sell only on cash, of course, the phase 2 will not exist. What is the duration of this phase 2? The duration of the second phase of the operating cycle is dependent upon how long the finished goods are held in the warehouse. How long you have to hold the finished goods in the warehouse? That is again determined by the demand for the same. Therefore, the second phase of the operating cycle is determined by the finished goods holding period. That means holding the finished goods till they are sold, when you can sell only when the demand arises, right? Now let us discuss about phase 3, wherein the receivables are converted into cash. Here also the duration of this phase is dependent upon various factors which may vary from one firm to another. This is basically dependent upon what collection policies the firm adopt, what collection procedures firm adopt to collect the dues from the customers. Okay? This is what we understand from the operating cycle. If you remember, students, you have already visited the cashew factory. You know very well what is the manufacturing process of the cashew factory, wherein the cashew factory purchases raw cashew nuts. It will be held in the form of stock of raw cashew nut, and then you start the manufacturing process starting from drying till the grading and packaging. You go through various manufacturing processes. After that, the stock, finished stock will be dispatched off. Normally, it will be shipped to other countries. And again, there is the time gap to get the cash on the bill. Therefore, this process takes the time, which makes the funds being blocked in various components, there creating the need for the working capital in the organization. Here we come to the end of the first A class, and these are the questions for you to think about, and these are the learning points of our next E class, which we can have shortly. Thank you, students. Thank you very much.